The stock market is selling off. The NASDAQ index is in correction territory. Bitcoin is down more than 16% in the last month, and investors are afraid that we're heading into a recession. So, what does that mean for you and your money? Is this a time to sell and wait, or is this a time to start buying the dip? Are we going to go into a recession soon? I'll address those questions in this video here. I'll first discuss the latest economic picture and if it looks like we're heading into a recession or the health of the US economy. I'll also address the tariffs presented by the current administration and what it could mean for the US economy and what it could mean for some of your investments. And finally, I'll answer if this is a buying opportunity or if investors should sell and wait for all this volatility to end. I'll discuss all of that in this relatively short video. So let's get started. So at the top of the video, I highlighted all of the signs of investors feeling more afraid about the prospects of the economy. The VIX index, which measures expected volatility over the next month, that's up 47.8% in the last month. So this is a lot of investors betting that we're going to see a lot more volatility in the near term. So investors are bracing for more volatility in the near term. Already, we've seen the QQQ index, which is a proxy for tech stocks, that's down over 10% in the last month. The S&P 500 is down almost 7% in the last month, and Bitcoin is down over 16% in the last month, despite the presidential administration here in the United States taking very friendly stances towards cryptocurrencies, initiating the reserve policy for cryptocurrencies. Despite those good developments, despite all that good news, Bitcoin prices are still down more than 16%. In other words, what this brief chart summarizes is investors getting more cautious, taking a more safe approach to their investments, a risk-off approach. And that's causing prices to come down, and that's fueling a further sell-off. But is that justified? Are we heading into a recession? Well, let's take a look at some economic indicators that will give us evidence of the direction of the economy. First of all, the thing I like to look at is unemployment. For me, jobs are a very important factor for the economy. I weigh this much more than anything else because if people are working, everything seems to go smoothly. It's when people start getting laid off and people are unemployed where I start to see difficulties and challenges in the economy. And this chart tells me two things, okay? First of all, let's look at since this bottom here in 2023, where the unemployment rate fell to around 3.4%. The unemployment rate has been steadily rising since 2023. You see that uptrend here for the last 2 years now. The unemployment rate has been ticking up. But at 4.1%, this is on the lower end of where the unemployment rate has been in the US for the past several decades. So despite the fact that the unemployment rate is going up, the unemployment rate is still at historical lows. This is a relatively healthy sign for the US economy because the bigger trouble we have right now is in shortages, is inflation. Businesses have a hard time finding qualified workers for the jobs that they have available. The companies that I'm following that need people to be there in person, I'm talking about companies like Domino's, right? The companies that need drivers, Starbucks, McDonald's, these companies that need people to be there in person, they're still having difficulty finding qualified people to come and work at their companies, at their businesses. So businesses, if I was to just give you a broad, very broad opinion from businesses and what they feel, they still feel like employee shortages are a bigger problem for them right now. So having a little more slack in the economy is a relatively healthy thing right now because inflation is still a problem, and I'm going to talk about that in a little bit. So unemployment rate is going up, but it's going up very slowly and it's still near historic lows. So that part of our economy, the US economy, is still very, very strong. Now, the unemployment rate is a backward looking indicator, right? It tells us what's happening in the past, something that I look forward to, or is a economic indicator about future unemployment rates, is the initial claims for unemployment insurance. When people get laid off, they file for unemployment insurance. And so if there was a increase coming within a month that we haven't yet seen in the unemployment data, we would see it in the unemployment claims data. And you could see here the initial claims for unemployment. This is going back 3 years. This number is not alarmingly high and it's not increasing. It's been volatile up and down, but relatively stable. This means businesses are not laying off people. So you have a very healthy number of people employed and you have businesses not laying people off. So looking at the employment picture, the US economy looks strong and improving. I quickly wanted to let everyone know about this great offer for my channel members at the investor tier. You can gain access to my spreadsheet containing my ratings on over 130 stocks. I update this spreadsheet with multiple times and multiple changes per day, Monday through Friday. Additionally, channel members at the investor tier can get access to my spreadsheet with my discounted cash flow valuations, and I update this spreadsheet multiple times per week with multiple new companies added to this spreadsheet with discounted cash flow valuations. There's already dozens on the spreadsheet available now. You can get all this plus early access videos, plus member exclusive videos, plus priority response to comments, all for less than $15 per month. So what are you waiting for? Hit that join button below and start experiencing the benefits. Now let's turn our focus to inflation, because this is the area that's posing the biggest threat to the US economy, is inflation, especially connected to tariffs, because tariffs are inflationary. It increases the cost of goods that businesses have to pay to import products. Okay, so businesses have to pay, depending on what country we're looking at now, 20% higher import prices on products from China, 25% import increases in prices from Mexico and Canada. And the president is talking about reciprocal tariffs and tariffs on steel and aluminum and lumber, etc., etc. So all this means that businesses have to pay higher prices for the goods that they're importing. And then after businesses pay those higher prices, they have to make a decision. Do they absorb those higher costs and keep their prices the same in what they charge customers? Or are they going to increase the prices they charge customers? I think it's most likely that they're going to increase the prices they charge customers. And so consumer prices are going to increase. And as you see, after a couple of years of inflation improving, moving down from above 10% in one moment, all the way down closer to 2.5%. But in the last few months, inflation has ticked higher. So let me zoom in. This is a 3-year chart. Let me share with you the 1-year chart. And you can see here, after approaching 2.4%, inflation has consistently moved higher since about October of 2024. And so you have this inflation moving higher already in anticipation of the buoyant economy that people expected with President Trump and the Republicans winning the US election. Investors expected a improving economy, and so they bid up a lot of asset values, and that created the wealth effect, and then people started spending more money, and so that created an inflationary surge again. So couple that fact with now we have the tariffs going into effect, that could threaten a rising inflation that could get out of control. Already, we've seen central bank officials point this out and say, look, before we cut interest rates anymore, we're going to wait to see the impacts of these tariffs on the economy or the impacts of President Trump's policies on the economy. So the central bank is no longer enthusiastic about cutting interest rates. They're now more concerned about inflation, which they had become less concerned about. They thought their job was almost finished here in October of 2024. They thought, like, man, we dodged a bullet there. We really avoided a big inflationary surge. Inflation is under control now, but now those risks are rising again. So I don't think the central bank is going to take any chances, and I don't think they'll be cutting interest rates anytime soon. Now, the good thing about the US economy in recent years is that productivity has gone up. A couple of big factors are helping productivity. Most notably, artificial intelligence is making employees more productive. Businesses are able to do more with the same amount of people or do the same amount of work with less people. And so each person is more productive, and that helps output, which keeps inflation under control because the economy is producing more things. When you have more things, that helps inflation come down because it's dollars chasing after more things. So the price of each thing doesn't have a chance to go up by as much because businesses can produce more. There's more flexibility in the economy. And so that's a good sign. The productivity improvement from AI and then remote work is also helping improve productivity. So long as productivity continues to remain solid, I don't think inflation will get out of control as it did during the pandemic, because during those moments there was huge supply constraints which limited the flexibility of the economy to produce more things in response to the greater demand from consumers. That's mostly behind us. So these tariffs impacts, I don't think are going to have that much of a detrimental effect as much as the supply shock did during the pandemic. Don't get me wrong, tariffs are inflationary, but I don't think it's going to be near as inflationary as the supply shock we got during the pandemic when businesses were restricted in their output. So already businesses have begun preparing for tariffs. You can see here US imports, this is monthly imports, surged in the last couple of months in anticipation of tariffs. So what businesses are doing is they're front loading all of their purchases right now for whatever they're going to need for the upcoming year, maybe the upcoming 2 years. They're buying it all now before the tariffs go into effect so they don't have to pay those higher prices. And they get ahead of the game here. And when competitors go to buy products 6 months later, competitors are paying higher prices and they can't compete in the marketplace. So imports absolutely surging already to get ahead of these tariffs, businesses building up inventories. And so that could somewhat mitigate the effects of tariffs if they're short-lived. If the tariffs are short-lived, they won't have such a detrimental effect on the economy. If they're longer-lived, they could still have a very negative effect on the economy in terms of rising prices. And then, of course, it remains to be seen what the long-term impact are of these tariffs on the U.S. economy. Is it going to improve the U.S. economy by bringing more manufacturing jobs back to the U.S.? That could be the case, but that's going to be more of a longer-term effect. The near term will be more pain. Longer term, the gains may come, they may not come. That remains to be seen. As a percentage of GDP, US imports had been declining since the first administration of President Trump. You could see when President Trump first took office, US imports as a percentage of GDP were around 15%. Now they're down to 14%. And I wouldn't be surprised if this number continues moving downward. So they are having the desired effect in terms of getting the US to import fewer goods as a percentage of GDP. All right, so back to the question I posed in the beginning. Is this a buying opportunity? I would say yes. And I would not try to pick a bottom here. I would not try to be timing the market. I would just say, all right, there's a few stocks that I've liked that I have on my list. Let me just start buying them now, and let me have a plan where I can just keep buying them every week for the next 6 weeks, for the next 12 weeks, for the next 18 weeks. If prices remain volatile and prices continue falling, just keep allocating on a weekly basis over the next several weeks. This is a great time to be accumulating shares of stock. I don't think this is a time to be selling or divesting from your portfolio. This is a good time to start buying, to start adding on a dollar cost average basis. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.